This is the Golden Rule with David Fischer. For the latest information about bail-ins, bailouts, the economic collapse, and much more, go to landmarkgold.com. Now, here's David.
Welcome to the Golden Rule. This is David Fischer and podcast number 51. The markets are closing at all-time highs again. And, what we're not dealing with is the problem of our debt, like I mentioned in podcast 50, and our country's debt, our global debt, and central bank debt. What we are talking about, though, is how the markets are at all-time highs and how strong they are and how the market will keep going in its rally and all the reasons why this will happen. This reminds me in the year 2000, before the tech bubble burst, and in 2001, there were people coming out and saying by 2010, the Dow Industrial Average would reach 25,000 points. Here we are, 2017, in the huge downturn of '08. And we're not even quite there. We're getting close to that. But, people came out and said just crazy things. Some people are coming out and saying crazy things today, too. And but there are a few people out there every week that's a growing sentiment that tempers the cheerleading of the market. Because historically, 99% of the people in 2008, that was on CNBC, before the market corrected in 2008, we're talking about how the market was going to go much higher. And all the fundamentals there. Look at how much corporate profits were happening. Look at how much was happening in the economic development. And the major underlying things, like the debt, was being ignored. Not even talked about. It's not a very fashionable thing. We're in the same environment again. But a few people are coming out there. Every week starting to talk about it now because I think it's more of a reality than not. David Stockman, the former director of the United States Office of Management and Budget under President Reagan, has been a very advocate and strong opponent against what I also talk about, the debt structure of our country, of individuals, companies. The banking system hasn't recovered. They're putting Band-Aids on the problem. The international markets are not based upon true recoveries. He's saying that central bankers have created a massive bubble. All the things that I've been talking about, David Stockman has been talking about, but now he's fine-tuning on an area in the car sector. In fact, he's calling on that this is running a cycle also that's going to bust here. He calls it Carmageddon, actually. He's saying this, that let's look at what the Fed has done. They create boom and busts. And now they're doing that in the auto industry. They're saying auto production has risen since its low back in 2010, 130%. But the overall industry, the industrial production, is actually no higher today than it was in the fall of 2007. Real production in most sectors of the U.S. economy has actually shrunk considerably. That means if you subtract the auto sector, there has been zero growth in the aggregate industrial economic environment for a full decade. So the automobile industry is actually distorting the effects of monetary central planning. So there's been a financial assets, a boom and bust cycle and caused by monetary central planning, in other words, manufacturing of debt. He goes on and says that get ready for Carmageddon because they've changed the criteria. Remember what happened in the industry of mortgages? They changed the criteria for you to apply for a loan. You didn't have to do full documentation. All you had to do is breathe against the mirror. There was no qual doc is what they called it. You didn't have to put money down even. So they changed the normal criteria of getting a home loan, and thus creating an artificial bubble that burst through a low interest rate environment that affected the United States and the world. It's happening on a much smaller level, but the same principles are happening in the car industry. When you consider the fact that credit analysis in the auto sector is now being overwhelmingly driven by what you call the collateral value of the vehicle. In other words, what the value of the vehicle is when it's being turned in, not the credit worthiness of the borrower. This is a change in the major criteria. It should always be based upon the borrower, his or her credit scores, debt-to-income ratio, things like that. So if we saw car prices fall sharply losses from loans default then would soar. This has happened before in cycles. And this could happen again because the criteria for getting a car is not being based upon the normal fundamentals. During April, for example, prices for most classes of used vehicles plunged sharply, according to the J.D. Power Index, which was down 13% in that month. Needless to say, the drop in the used car prices could now be accelerating. But, we're a long ways away from a crisis rising in the used car industry. But as maturity leases and loans materialize, that could hit the markets because there was a huge aftermath of loans and of cars following the crisis of 2008. And so if you look at, there's a pattern that people buy or lease a car for 3 years and then turn it in. And every time they do that, they're rolling over the debt. And now it's accumulating after the third time because we're 9 years into this about. So that's why they're saying this next time around. So 9 years, 2008 and 9 years on top of that brings us to 2017 for simple math. 3 years of rolling over a loan or a short term is, 36 months. So they're rolling this over now. They're not looking at the person's ability to get a car, but the equity or the lack of equity in the car. Rolling into the next loan, seems to be the behavior that putting the problem down the road and not taking care of it today. And this could all come and burst. This bubble that's being created in the car industry called the Carmageddon is what David Stockton is referring to. I don't know how factual that is as far as how big of a bubble it could play. The numbers are true. It's definitely is happening. And that is the disclaimer that Stockman does say, but he brings up a bigger point. Normal fundamentals are being ignored when you get a loan. Normal debt ratios are being ignored on a personal and a governmental and a central bank level. And those will come back to haunt us. That's the bubble that he's talking about. And this goes in line with that. There are other people coming out saying that when this happens, the stock market will correct. And so there's articles now coming out that, how hard is it to get out of a stock before it becomes a bear market? And the numbers are actually startling. It's very difficult to time that. Most people get sucked into it. I've dealt in the financial industry now coming up in August. It'll be 25 years. And when I talk about to ask people what their exit strategy is, they say they basically don't have one. I asked them if the stock corrected 10%, would you sell? Well, I don't know. We'd wait and see. So, some people wait for the correction to happen and then the market goes down. Then they say, I just want to stay a little bit longer to see if it'll go up and I'll recoup my losses. So what happens, they get tied into this bear market. And now the reports are coming out. Market Watch came out and it said the odds of sidestepping a bear market are even lower than the previous thought. That's saying something since the odds were already known to be dismal. So it's very challenging to predict this, but there's a deep down sentiment that people feel that something is wrong, that the markets are overvalued, the economy is not really developed, it's not a true economic environment that has got back to health since 2008, and we put a Band-Aid on the problem. We look at even the sentiment. I've been doing some reading on history. In 1929, prior to the crash, people believed that everything was going great and would always do so. The feeling of optimism was in the air that you can't even describe in reference to today. Then the hit happened of 1929, which is different from the Depression. A lot of people put that in the same category. The Depression came as a result of 1929. America came out of World War I with the economy intact, and we were the only strong country in the world, and the dollar was king at the time. We had a very popular president, Calvin Coolidge, and one that was even more popular that was elected in 1928, Herbert Hoover. So things looked pretty good. This is the Roaring Twenties. Well, let's take a look at that. The Roaring Twenties, it roared. It was not based upon a fundamental. The boom happened. 1929, the bust hit. At that time, some of the most wondrous inventions were happening, and it was the age of consumer credit. Before 1920, the average worker could not borrow money. By 1929, though, the ads read, "Buy now, pay later." Sound familiar? That had become the new way of life. So many people believe that there is a belief that deep down 1929 was going to happen when it was in the roaring 20s, that it couldn't go on forever. The thought was the pools were more like musical chairs, and when the music stopped, somebody owned certain stock, they were going to be the ones to suffer. And today is no different than 1929. It might not be the same downturn, but getting out of the market is never an easy thing emotionally when the market is down. So when it corrected in 2008, I talked to a throng of people who said they couldn't get out because they couldn't lose that much money, only to realize that a 10% loss was nothing compared to the 45% loss that they actually took. And they had to wait 7, 8 years, 6 years, 5 years at the minimum just to break even. That's why they call this the lost decade. So my advice is, if you feel there's something that has telling you in your gut, your spirit, the voice of the Lord, whatever you want to refer to it in your life as, that's giving you a nudge, a warning saying, don't have all your eggs in that basket. Do yourself a huge favor. Listen to it. Diversify. We advocate, get some metals in your portfolio. Don't have 100% in stocks. This time there would be a bail-in, more than likely. If you want to learn about that, you can call my company. I'll give the number out in a second to get a free white paper, an 8-page white paper in detail that gives all the pieces of the puzzle on the criteria. Since we're talking about it, I'll give the phone number now, 855-747-5947, or you can go to landmarkgold.com. I'll say the number slowly, 855-747-5947. So prepare in advance. In 2008 happened. Gold went up 72% in the first year and went on a multi-year run, while stocks plummeted 45%. There's a brewing sentiment that we're approaching another bubble. If you feel that way, call my company, get some information, learn about it. This time they can seize your money, unfortunately, because of the Dodd-Frank Act. I have a whole white paper on that, too. So until then, this is David Fischer, the CEO of Landmark Capital. You've been listening to The Golden Rule, podcast number 51. Take care. God bless.
This has been another edition of The Golden Rule with David Fischer. To stay up to date and to find the latest information, go to landmarkgold.com.